Some more learnings from the equity market, and these learnings are easier in a bear market than in a bull market. But having said that, let me still say some of the things that I have learned. One, simplicity is better than complex things. Whenever somebody comes with very complex products and starts by saying, sir, the opportunity in this market which is not in the listed space is much better than in the listed space, I just put a full stop, because I do think all the greatness that this fund is going to achieve by in the markets, whichever market, real estate or art or venture capital funding or anything like that, is completely lost if the entry and exit can be decided by one man or one group, right? So many big fund managers, including Franklin Templeton and all of them, have made a mess of some of these opportunities, and I will refuse to accept that being unlisted is a huge advantage. Yes, you will constantly see something saying venture capitalists have got so much money and they have done this to their fund, but I know two venture capitalists who are willing to admit to me that their funds, if they invested in say 10-12 companies, one or two have performed better than the index. All others have lagged the index, which means they have lagged some frontline fund managers who have done well over a 20-year period. And when I'm seeing a venture capital, I prefer looking at a 20-year track record or a 15-year track record than a 3-year track record, right? I don't want to see that. Similarly, if they come and tell me here is a fund which invests in real estate or here is a fund which does VC funding, to me, the fact that it is not simple for me to understand and that it is going to be unlisted is bad enough for me to stay away from such funds. So let us come to the basic simplicity, which means if you don't know where to invest and you put money in an index fund, could be a world index fund or an India index fund, over a 20-year period, if you just abdicate your responsibility about seeing every quarter what it is doing, every month what it is doing, you will be better off than trying to pick stocks and funds on your own. You will just not be able to do it as efficiently as the market forces do. There is enough research to show that you're investing in 50 companies, out of which 60% or 50% will go FUT, but 10 companies which do very well will be able to give you sensationally good real returns, which means returns post inflation and post taxation, and that's what we are all aiming for, right? So another thing is we totally underestimate our ability to adapt to new things. If you take the markets today, Indian market or the US market, the top 15 companies, or at least the top 10 companies would not have existed 15 years ago. They were just not there, or they were there as very small companies in which you had no guts to put money. Let's say you put money in Amazon or something like that. The standard deviation in the return is so high that you would have got off somewhere saying, oh my god, I escaped, see the market, see how much it has fallen, and from there it would have again risen and you would not have had the guts to buy it. Unless you bought Amazon at the beginning and then did not touch it at all for such a long period of time, which is very difficult for most of us. So even though it is easy to say, oh, I did it in Infosys, I did it in Wipro, I did it in HDFC, ask yourself what is the amount of money at stake. If it's a seriously big amount of money, let's say you put 20% of your net worth in Amazon when Amazon was beginning, at some stage it would have given you such gut-wrenching returns that you would have said, somebody else advising you on your portfolio would have said, that's enough, just get out. So sometimes it happens that we will sell because somebody else says, but we have fantastic ability to adapt, and once we adapt we can't go back. Can any of us today live without Google, without a cell phone, or without, let's say, go back 100 years, could we have ever lived without electricity? We just assume that these things will happen. So we will adapt, we will buy, we will sell, we will do all those things, but we may underperform some of the fund managers, and that's perfectly all right if you can meet your goals. One more learning is many things which look absolutely unnecessary and expensive and terrible and useless at the beginning look like they become an addiction. Can you imagine when the cell phone came and it used to be 64 rupees per minute for a call? The first reaction was, are you mad? Why would I ever have a cell phone, right? This must have been the reaction by most of us in maybe 94, 95, 93, 94, 95, when the phone was so expensive, or whether the calls were so expensive. Phones were that time not so expensive, but I remember paying 20,000 rupee monthly bills, or 20,000 rupee 2 monthly bills for my MTNL phone, and that was the way to go, right? So you have to reach home early to take a call, you have to leave the office late to make a call, right? So you have to do all those things. Then the phone came, we all laughed and we said, we don't need this. I remember 1982, 83, we must have wondered, why do people buy Bisleri water in such good hotels where the water quality is anyway good? And then we realized these are NRIs, and we would laugh at NRIs saying, oh my God, they're buying bottled water. But today we are buying bottled water. We are not even comparing it to tap water prices, are we? We are not, because tap water is free in a hotel. But we say, no, give me Bisleri water. I always say that if I can eat your food, I can drink your water, right? It's a call that we take, but we adapt. We do that very well, and we laugh at those companies which make water, and suddenly one day when you find Bisleri being sold to HUL for 4,000 crores, you'll wonder, my God, so much money. So I have laughed at things which I cannot live without today, right? So these things will happen to us, and some of these things we will learn, some of these things we will adapt, some of these things we will invest and make money, some of these things we will invest and lose money, right? If you were an investor in Orkut, you would have lost money. If you were an investor in Coup, you would have lost money. Not that Coup was bad, but the biggies, the WhatsApps and the YouTubes and the Twitters of the world can also ensure that the competition doesn't come up. It may be very subtle, but it does happen. So if you are a small investor like me, you are better off riding the biggies rather than fighting the biggies. I mean, I did that in my business. I sold out my broking business and went into training, because it's much better to become a vendor to an HDFC, ICICI, Kotak and Templeton rather than try to compete with them in broking or in asset management or things like that. You can't. So it's better to become a vendor than to become a competitor, right? So today, if Jio comes with a mutual fund, it does not bother me because I am not a fund house. If Jio comes into broking, I am not worried because I am not a brokerage. But if you are a small businessman and you know that Amazon or Reliance can come into that business, you have to pray a lot, right? Also, one more thing which I have noticed is, I don't know how Warren Buffett or Chandra manage such a big range of companies, because what works for one company does not work for another company, right? So an Indigo, which did not chase profitability, it's a very frugal company, let's make no mistake about that. But in the initial stages, it was chasing for market share. Now that it has market share, it is chasing for profits, right? So every company mostly goes like that, saying first they chase the top line and then they chase the bottom line. That's a sensible thing to do, because you have to be alive. To chase bottom line, you have to be alive, because if you are not alive, if you are not significant, if you don't have decent market share, then you're dead. After that, there can be no profit. So initially, when say Indigo was 800 rupees, then none of the ratios worked. The PE ratio, nothing worked as long as you make losses. None of the RONW, ROE, ROCE, nothing worked. So the analyst looks at it and says, oh, look, there is nothing happening in the company, which is true. But having chased top line, now it is chasing bottom line, and the share has gone from 800 to 5,000. Similarly, if a company just chases top line and does not chase bottom line for a very long period of time, sometimes it does well, like in case of Amazon, but sometimes it doesn't do well. Similarly, when companies pay a lot of incentives, sometimes it works because the employees are nicely driven towards achieving the incentive, but sometimes they take so much risk that the company goes fat, like Lehman Brothers. What was wrong with Lehman Brothers? Nothing, but they were looking for short-term and long-term increase in the shareholder value, because all the employees, especially at the top, had ESOPs, and that was the only thing that they were chasing. They were all all chasing the share market value, which means perhaps they took too much risk. They did not understand the risk they are taking. Your incentives blind you. There is no doubt about that. Your incentives blind you. So it is easy for an mutual fund distributor to shift from a big fund house to a small fund house, to shift from a higher risk, from a lower risk, good return, giving a reasonable growth scheme to a more risky scheme. It is very easy because the risk is being taken by the investor, and the gain is being got by the advisor. So right, so some of these things will happen. You have to be alert to see what's happening. So some of these things, some things look unsustainable and unreasonable, and you keep wondering, why will a Tamilian buy idli batter from the shop? Well, it's a big business today. Why will every restaurant in India has people, boys who will come and deliver? There is absolutely no doubt. There are enough restaurants near my house where if I called them and they would deliver. But today they don't. They know they are happy with a Zomato coming and taking it and delivering and charging 40 rupees, because the shop itself could not have charged. Then people would say, oh, chutta nahi hai, I can't make the payment, and things like that. So Government of India creates an UPI, somebody else comes and creates a Zomato, somebody else creates a Jio creates extremely low cost telephone lines, and therefore a Zomato makes money, right? It is so the cost has to be low, cost of delivering has to be low, which is low because in India there are young boys, now I heard even young girls who are available to do this work. They are making money. It's not employment, but it's a place where some guy can go and work. I have seen Zomato boys and Ola Uber drivers working 20 hours a day. Can you imagine? They start the day at 1 a.m. somebody from Zomato will deliver tea to your house. Some kid is working at that hour, right? So these kind of things happen. You keep wondering, will it happen? Why will a Zomato work? Well, Zomato has worked. Why will Swiggy work? Well, Swiggy has worked. Why will an Ola or Uber work? Well, they have worked. Have they created jobs? I believe they have created something like 7 million jobs. So there is happiness all around. So some of these things you keep learning, you realize one thing: never say no to a company at the start, because you don't know how things will happen 5 years, 7 years later. Let me repeat what I said. If you see the top 5, 10 companies internationally or 15 companies internationally, they did not exist 15 years back, and today they are the highest in market cap. Remember that while choosing your shares. Thank you.